My name is Will Sanchez, and I will mostly stay out of the way and serve as a moderator for this panel. We've got a very nicely, colorfully titled session, which is Show Me the Money. Evaluating relationships, Evaluating and building relationships with investors. I don't know about everyone out there, but I've really been looking forward to this all week. I'm pretty excited. It should be a lot of fun. The goal of the panel is to, from the description, you might remember, unpack the subtle and complex questions that every founder faces as they approach investors. So really hoping from our panelists to hear a few unvarnished stories of success, failures, and just different vantage points. So we've got a pretty all-star crew here from the greater Boston ecosystem with I'd say significant influence and impact at very large scales. We've got venture builders, creators, investors, operators, innovators across energy. What do we have? Online marketplaces, semiconductors, business products and services. I mean, we span the gamut. Just to set the stage, over the past few weeks, we've had a number of pretty fruitful discussions on this topic of this session. We have prepared a list of what we think are interesting questions and put them into a few buckets. So we'll do some introductions. We'll pick some of these questions just to get the juices flowing. Each panelist will, I'll point to a panelist to give us a quick response and keep it brief so that maybe we get a few panelists in on any question, and if you'll just jump in as well. I'm gonna try my best on the chat to pick themes that may emerge. What I want to do is I've asked each of the panelists to introduce themselves, maybe 2 to 3 minutes, give everyone a sense for who we have here, if you haven't checked out their backgrounds. That said, we're really here for you. So, we're not going to use Slido. We're just going to use the Zoom chat. So throw your Q's, C's, or wows, your questions, comments, or concerns into there, and we'll do our best to prioritize from there. So, without further ado, let's get going. We ready, panel? Are we ready?
Ready.
All right. I actually didn't pick I'm just going to go in the order, alphabetical order here. So. Liz, if you don't mind doing the quick introduction, then we'll go Amy, Donna, and Nadia. Does that work?
Sounds great. You tricked me. I was looking at Amy like, all right, definitely first. I'm happy to kick off. So my name's Liz Kane. I'm a partner at OpenView Venture Partners in Boston. My background is in operating roles. I spent a couple of years working for a small startup that was acquired by NetSuite, large ERP and accounting software, and then spent 8 years there building out different parts of go-to-market across sales operations, account management, selling into the install base, and then built the top of funnel team doing lead qualification, outbound prospecting, and inside sales. Had a large global team. It was a blast, but I really wanted to get back to my startup roots. And so about 5 years ago now, I joined OpenView. And my role at OpenView today is leading our investment team and really thinking about the systems and process and tools that allow us to get coverage and meet all of the amazing founders that are out there and help us identify the companies that are really prime for investment from us. And we're looking at companies that are B2B software, what we call the expansion stage, really companies who have found product market fit and are at that inflection point of scale where they're starting to see repeatability in the go-to-market motion. So we're based in Boston, always looking to meet new great founders and very excited for this conversation. So thank you for having me.
Awesome. Thanks, Amy. Sorry, Liz. Next, Amy.
Thanks, Will, and to the entire Startup Boston Week team for having me. So Amy Dufour here. I'm a principal at Prime Impact Fund. Prime is an early stage VC fund based in Cambridge, and we invest in transformative technology companies with the potential for gigaton scale climate impact. So as a principal, my role is to lead investments and sit on company boards. In terms of how I got to Prime, it's been a bit of a journey. I've got a hybrid background in business, finance, and impact. So before moving to Boston just over a year ago, I was a renewables and investment banker at Bank of America. So I worked with public and private companies to help them raise capital. I think the most meaningful thing that I worked on was the IPO of Sonova. It's a residential solar company. And being able to travel around with the management team who built the company from the ground up for their IPO roadshow. And I was there when they rang the bell on the New York Stock Exchange. It was such a privilege to see an entrepreneur's dream of going public become a reality. And then in addition to spending some time on Wall Street, I also used to live in Singapore. And there I ran early stage social venture accelerator programs around Southeast Asia. So have a lot of experience being on the ground with entrepreneurs in the Philippines and Singapore and Malaysia, helping them think through their pain points. But I got really religious about climate change. I figured if we don't solve that, nothing else matters. And that was one of the key kind of impetuses for me to make a transition to an investing role within the broader climate tech space. So just a couple of stats on Prime Impact Fund. We're just north of a $50 million fund. We invest in pre-seed, seed, and Series A rounds. We typically put to work $3 to $4 million in total per company. Half of that is initially invested up front, and then the other half we reserve for follow-on investments. And the key innovation in the Prime Impact Fund model is that all of the capital that is coming into the fund is what we call catalytic. So it's in the form of program-related investments, which are typically used by foundations, mission-related investments, which are equity subscriptions and recoverable grants. And we want to use that inherently patient and flexible capital to de-risk early-stage climate technologies for follow-on investors. So I'm really excited to be here today and talk about showing me the money.
I love it. Thanks, Amy. So we've got, interestingly, Liz and Amy will bucket you as the investors. And so now Donna, Nadia, you sort of straddle both, but we move to operators. Donna, your intro.
Sure. Happy Friday, Startup Boston. So I'm Donna Levan. I consider myself an entrepreneur who masquerades as an academic. I have been at one bootstrap company. I will not tell that tale publicly. You can, hit me up offline if you ever want to talk about that. And then 3 VC-backed companies. One, I'll date myself, thought we were going public when the bubble burst. The second one, You Promise. There's a whole You Promise mafia in the startup scene in Boston. You Promise was acquired by Sally Mae. And then the last one was Care.com, where I was a co-founder and took Care.com for 0 to 100 and had that, pleasure of the IPO and ringing the bell and then everything that happens after that. I've been very fortunate as I transitioned into academia to teach at MIT with Will, to serve as an entrepreneur in residence there, to serve as an entrepreneur in residence at HBS. I'm currently, for at least the next week, overseeing innovation and entrepreneurship at WPI, where I focus on getting hard tech and science out into the world. And I'm also teaching at HBS right now, a class on launching technology ventures. And soon, hit me up this time next month, where I will be at Babson as the CEO of the Arthur M. Blank School for Entrepreneurial Leadership. All about the operators, passionate about all things entrepreneurship, and looking forward to the conversation.
Excellent. Thank you, Donna. Great to have you. And that leaves it to Nadia. You're up.
Good morning, Startup Boston. Thank you, everybody, for joining. It's a great privilege and opportunity to be here with everyone today. So my background is technology through and through. I'm also not going to date myself like Donna. From building it from researching it to building it to operating, I got to also founding companies, and my last company that Will is very familiar with, because we were founders together, parallel companies being launched out of spun out of MIT, was semiconductor and energy savings, and that was acquired by Murata Electronics, the big Japanese conglomerate, back in 2017. But I'm a serial entrepreneur, technology, specialize in B2B. And so on that front, and I'm currently a co-founder in also a B2B physical commodities trading platform to make our huge, enormous $20 trillion supply chains more dynamic and responsive to our needs in COVID. And as an entrepreneur and operator, I need all the help I can find and I can get. And it's always a very, very humbling challenge. On the other side, on my other hat as an investor and mentor, board member, advisor to outstanding entrepreneurs, some in the Bay Area, but primarily in the Boston area, that is always my privilege, and I learn so much from everybody, and that is always extremely exciting and a huge, like, I offer the learning, but I get at least as much learning in return. So yeah, I mean, without further ado, I'll just turn it over to Will. So basically I can, with Donna, I think we can straddle both sides and put, either hat on, depending on what your interests and questions are. Thank you.
All right, that is fantastic. So hopefully we've got, wow, the attendee list just skyrocketed before we're at over 100 people. That's fantastic. So I see a comment, dating yourself is not a bad thing. There's a lot of wisdom here, a lot of experience. So I think the panel has done an amazing job distilling into key points some of the ways we think about the investor-founder relationship. So let's dive right into it. It's just another relationship. You've got those with the money, those asking for the money. What's really the big deal? What are some of the common misconceptions? And I'll throw this one over maybe to Liz first about this dynamic between founder and investor. Why is it, what's the big deal? What are these misconceptions?
Yeah, I mean, I guess we can look at this a few ways, but I think one of the things that I would encourage founders in particular to think about is just keeping a really open mind as they're talking to investors. And I think kind of exploring those partnerships from all sides. On the one hand, I think one of the misconceptions is that investors should be like 100% with you as the founder. And there's this concept of like founder friendly investing, and at times doing like the best thing for the company may not be founder friendly. And so thinking about that kind of from the get-go and what you're expecting from your partner is really important. And then on the flip side, if you just go to the other end of the spectrum, I think thinking that there has to be any sort of adversarial relationship. This truly is a partnership. You're taking money so that you can get additional expertise around the table, so that you can grow your business faster, so that you get access to a broader network, right? There's lots of great reasons why you would choose to partner with an investor. And so, depending on kind of where you sit, just keeping an open mind and making sure you understand all the dynamics in play. That to me is sort of, as I think about misconceptions, there's just a lot of ability to not look at the entire spectrum and understand kind of what's out there. And then the other thing that I'll call out is just thinking about really like how much capital you need to take and trying to understand kind of who the best partners are at various stages, and continuously thinking about how do you make sure that your cap table has the people there so that, when you need to raise that next round, you either have access or the network to get it, or the money around the table with people who are going to be supportive of you in the future, thinking about sort of that longer term angle as well. I'll pause there, lots more, but I'm sure we can kick it to somebody else here.
Yeah, that's great. I want to there's a lot, we sort of just dove right in. Be curious to the audience out there. We want to be sensitive to, who is out there. We're saying cap tables and partners and this. And so if we use any jargon that is unfamiliar, throw it in the chat. But based on the sort of the program, some of these topics may have been discussed before. If we take a step back, maybe Nadia, I'll look to you. These misconceptions happen after some foundation. What do you, from the ventures you've been a part of, what do you view to be?
Yeah, so I'll share a complementary view to the one Liz just offered. And pre-COVID, the way, and this is a mistake I think not only first time, but repeat entrepreneurs make as well, is that pre-COVID, the way you meet investors tends to be in these professional but pseudo-social settings. So after the first conversation, if you start to engage, then you would often, go out to coffee, maybe have lunch, meet other partners, meet the investors meeting people on your team. So there's a lot of this kind of social interaction that happens. And investors do truly want to know their founders as people. They really invest in people. That is on multiple levels. And so they really want to understand how you think and how you operate and what your values are and so on. And so the misconception that happens from this, often occurs from this interaction, is that founders start to think that, oh, we get along great and we're buddies and homies and friends, and that's kind of our relationship. But that is, yes, you can get along well, but that is not the relationship that is being built. You're building a professional relationship. And I think the key aspect that founders need to remember is that the relationship is that of accountability, first and foremost, because you are forming a relationship or forming a relationship where somebody is investing in you, and you need to deliver with that investment. They are investing for a return, not because you're super cool. So that is, I think, the most important root of the tree misconception that we need to be aware of. And then following on that, if we are talking about expectations, I don't know, Will, would you like me to go into that other of what would be realistic expectations for an entrepreneur from an investor?
Well, let's come back to that. I want to try to. I see the chat is going wild, which is good. I'll take a look there and see if we might pull any topics. But I want to stick around a little bit on this dissonance that seems to come up with, well, we're buddies, and also I've got this, this is actually a professional relationship, and I've got these expectations on return. There's a fiduciary duty on both sides to perform, and how that, how do you, throw the question out, how do you manage this as either a founder, operator, or investor? Amy, you talked about an excitement that being part of the IPO process that tipped you over to the wanting to build ventures. How do you straddle that, excitement versus mission-driven, the purpose that got you to what you're doing today? There's the people part, and then there's the mechanics. That's a poor word, but how do you think about it?
No, I think that's a really, really good way to put it, and I really like what Nadia said about accountability. That word really stuck with me from kind of the last response, and it's a delicate balance. I think much of it is going to depend on at least from the investor side, what your fund strategy is. So I'll speak from Prime's perspective, because being a renewables investment banker for a bulge bracket bank has very different connotations than being an early stage mission-driven venture investor. And so what I'll say to that point, for at least on Prime's end, mission orientation is extremely important. I mean, we exist to address the existential threat of climate change. And if you as a potential portfolio company are not really interested in that mission, if there's not shared alignment in terms of our vision and goals, then that's probably not going to make sense long term, regardless of whether there is a really kind of steep or exciting financial return. Because at Prime, we are mission driven investors, and having gigaton scale impact is paramount above anything else. So I think, if I take a step back from that and think through what would be a good relationship for an organization or a fund like ours, aside from, shared mission orientation and goals, is I think it really links to what Nadia said about accountability. It's transparency. Look, being open and honest and transparent is really important to us. That's actually one of our core values. And that doesn't mean, we always agree. And I think, Liz brought that up in a great way, but being really open about where disagreements lie and providing responses and justification, at least on our end, in terms of where we think there could be delineations in terms of a particular approach or a product. And when we operate from a level of transparency, and we expect that from the founders that we invest in, we think that that's a really strong foundation for a good relationship, and also gives us a sense of whether somebody's truly mission aligned with us and our objectives.
I love this theme of transparency and communication, right? Because it's sort of the truth will set you free. When you're in the good, it's great, it's all lovely and fluffy. But when you're in the bad, right? This dynamic of this relationship, these are folks who are there to help you on both sides, especially the founder seeking the investor, right? So curious how you haven't actually decided who to start with on this one. So any of you can jump in. But what have you seen work or be productive in this in communication between founder and investor? And how do you, from a founder perspective, operator perspective, how does this not mean just having too many hands in the venture creation process, or I'm careful to call it having an investor who's too hands-on, right? How does that balance? What have you seen to make that balance work or not?
Can I hop in there, Will, on a few things? So yes, and to sort of everything that's been said by the panel, I wanted to sort of point out, though, that about being aligned with your investors, that alignment and your investors change with every series. So this notion of those investors who are saying like, hey, we are super founder friendly, a lot of those are pre-seed, when all you really have is the team and you have the founder, and it's like this big hope, and yes, they believe in you, and they should believe in you and your ability to take whatever it is that you're thinking about or this problem you want to solve, and to actually get a bunch of learning along the way and to get something out into the world. And the relationship does change over time. I think your investors want to see if you as the founding team can also continue to scale with your company. And this is where sort of this transparency piece comes in. I love that. You know what? Good news. The good news is about the learning. The bad news is about the learning. And having that transparency, I think the tension comes in when there's misalignment. Putting on my lens as a person who supports so many different founders, and many founders who unfortunately, lost their companies along the way. There was a fundamental misalignment when they took the money. And they were concerned when they took the original money, but they took money from investors or from funds where they were on life support. And, they didn't necessarily do their due diligence to make sure they're with the right firm or the right group for them. They took the money because they wanted to like live to fight another day. And, you know, you go along a way and you say you're, I don't know, a SaaS company, and you got people who don't know SaaS on your board and who don't really necessarily believe in you. It's a problem. It's the same thing if it was, you know, pick your sector. So just wanted to throw that out there on transparency and accountability. I think how you start is super important, even during the honeymoon period of getting into this cadence and knowing sort of what your investors expect from you, being open to their feedback, recognize that they do see the warts, you know, they see the sun, the rainbow in the warts. And so don't try and hide them, you know, have that conversation. And in some cases, they may have resources that can support you. So, you know, not to like pick one, but I know some people at OpenView, I know they pride themselves on having some folks on staff that can help you with things like pricing as you think about scaling your business. So if that's not your strength, it's okay to ask your investor for sort of help if they have that in-house expertise. I'll pause there.
I love it. It's more than okay to ask for help, always. Liz, you were quite into this. Want to add anything, or how do you view this?
It was funny. I was actually just reflecting on like each of the things we described, and I realized we jumped to the kind of post-investment relationship. And Nadia started to touch on something that I actually think is really interesting pre-investment as you're evaluating investors, in that getting to know you phase. And, you know, as you build a more personal relationship, I actually think one of the common misconceptions I've seen is that that relationship you've built will actually lead to an investment. And I think it's really difficult to sit in the founder seat and to be putting in so much time and effort with various investors and having the expectation that that can lead to an investment. And, you know, it's funny, I sort of liken it to like a sales process or prospecting and trying to understand, ultimately you are running an enterprise sales process. You're trying to get somebody to give you money though. And figuring out like where to expend your energy and which of those relationships is actually going to like become an investment. You're evaluating and buying and trying to understand from them, but at the same time, you're actually trying to get investment in your business. So there's this, I don't know, weird dynamic that happens there. And I think one of the few things you can do during that phase to really see what a partner will look like is treat them like they're already investors. Like, do they follow through on their word? Are they committing resources to you? Because it's very easy to sit in my shoes and to give somebody the time of a half-hour check-in and to have that relationship be developing, but make sure that like you're actually testing what the relationship, the working relationship would look like, and not just that kind of social aspect. So anyway, just kind of pulling those thoughts together at the start of an investing cycle too, not once you're, you know, already in it.
Yeah, so I love the description as an enterprise sales process, right? The product of a founder selling to an investor is risk. I am selling you risk. I have determined that and described the risk in a certain way, or we should rather call it a risk mitigation plan. Would you like to buy in exchange for equity? You give me cash. Right, so there is a transaction there. There's the personal piece, of course, the interpersonal piece. There's some questions that I'll pull out from the chat in a few, but Nadia, I think we talked. You've worked, been part of a number of different new ventures. How do you work this pre-investment process with your pre-existing network, right? How do you activate previous relationships for the new things you do? How do you, right? It's not a one and done type deal. The interpersonal part starts to matter as you repeat, all right? So it presumably gets easier, but not always. How does that look like for you in some of your ventures?
That's a really great question. Well, it's a huge question. So I will just comment that it does get a little easier if you stay in your, true sector. then you can have repeat investors, and there are entrepreneurs that are doing that, just really in the same sector again and again. However, if you're somebody like me who does it the hard way, who like kind of shifts all over the place, it's a lot harder. That's number one. Number two, the average successful company is about like 5 years. And so in that span of time, the investor landscape changes dramatically. The way, like say when I raised Series A for Arctic Sand, which was what, 10 million, that was 2012. And so in the last, say, 8 years, there's been a dramatic expansion in funds, a lot more specialization, a lot more funds that and investors that have kind of mushroomed for to fill niches that were necessary before and didn't really exist. There's a lot more pre-seeds, and so these kinds of network relationships need to be constantly updated, and you need to be on board of what's going on in the industry today. That's one like caution of somebody kind of emerging from a startup and saying, okay, I'm just gonna like go back. That may not necessarily work as well. The second, so having said that, the points that I want to make is there are several dimensions to the investment, and of course, I think this is clear, and everybody knows that on the audience side and on the panel side that there are different kinds of investors, from angels to institutional investors, VCs, very small funds, huge, enormous funds. As well as strategic investors, and the way they operate is very different, and the founders' expectations of these investors should also be different accordingly. So yes, money is money, but since there is that accountability and transparency, and you have to be delivering with that money, there's also this other side of what can founders expect from investors, and they can expect advice. They can, and the reason that I say advice is not because founders are stupid and investors are smart. Founders see 1, 2, 3. I mean, I have the privilege of just living vicariously through other founders as well, because of how involved I am in the ecosystem. But usually you're so focused on your company. So even if you're a repeat entrepreneur, you've done 1, 2 companies, right? And so your data points are single digits. The investor's data points on companies is statistical, right? And so the advice you can get from investors is extremely valuable because they have seen this before, a lot of it. They have a pattern that they can share with you and give advice from that perspective, and that can be extremely valuable. You should expect a critical assessment from them, and not like, oh, somebody on your team, great job, Nadia, yeah, this is awesome. You should expect, and this is a very, very strong expectation, for them to open up their Rolodex when you are in need at different stages, as Donna was saying, in building your venture, whatever it is, if it's hiring or reaching out to customers, or partnerships, follow-on investment, and so on. They're not going to do the work for you, but if it's a solid relationship, you should expect them to make these introductions. The way, yeah. So I can talk more. Maybe one other point I will mention is that investors are very good at benchmarking how you're doing against their portfolios, and so be attuned to that. Listen to that. Don't take this as something against you or negative. This is a benchmark that they do. This is how they decide how their investment is going, compared to, they have completely different incentives, and they are also accountable to depending on, you know, if it's a strategic, then to their company, how you're doing in providing, you know, or building the technology. If it's institutional, then to their LPs. So they have their own accountability that they have to do. And so listen to the expectations of the investors and their benchmarking, and see where you are on that front throughout all the stages that Donna and Liz talked about.
So Nadia, this is great. There's a lot to unpack there. There's a theme emerging around. So there's a founder operator side things to consider. Curious to hear from Amy and Liz as to, you know, there's, you know, a theme is educate yourself, founders and operators and investors alike. There's no smart or not smart. There's just, we're all work in progress, right? So there's this education and asymmetry and information that manifests itself in this relationship. Some, you know, the reference to the information investors have being statistically substantive is one way that asymmetry manifests itself. But I mean, we're in 2020, right? Information is out there. You go, you find it, you educate yourself, you walk into a conversation, and you are going to listen, as you just said, Nadia, to some very different things, very specific things that should attune or not. So I want to get to there's a question in the chat looking for what are telltale signs when you walk away. Before we get there, sort of what are you looking for, Liz and Amy, that works or doesn't work? Not necessarily specifically for OpenView or Prime, but some of these mechanics, right? What would you tell some of the founder entrepreneurs in the audience that you're looking for, or, you know, your colleagues are broadly looking for? And
in terms of making a potential, just to clarify, well, in terms of making a potential investment, or
so we want to get to the money. There may not be the current venture, but right, there's the building the relationship and then get into the deal, and the deal may be 2 or 3 companies later, it may be the current one. So what would you advise the founders as to how you're thinking about it, for those who may not have read Brad Feld's venture deals? You know, what are the snippets? How do you what would you distill it down to?
Yeah, I think I can take a first crack at that. We are, you know, I really think about investments as long-term relationships. They're kind of like a marriage in some ways. And so you really want to make sure that you want to be married to that person. And so I think a lot of the best founder-investor relationships that I've experienced, and, you know, my colleagues' experience, are ones that have actually started even before you're potentially seeking investment. So keeping people up to date, letting them know about that consistency with regards to any milestones that you've achieved. Sometimes I even think, like, if you're trying to raise money now, like, you should have engaged an investor 6 months ago. So I think, you know, starting early is really important, because that allows you to build that relationship over the long term, and also allows you to build that trust and that rapport. And I think that's something that, you know, particularly because we're an early stage investor and the team is really important. Oftentimes, you know, I'm thinking about the 6 out of the 9 CEOs in our portfolio, many of their first jobs with CEO, they were postdocs or grad students beforehand. And so making sure that you have enough touch points for that is really important. This isn't completely answering your question, but it was something that I wanted to bring up, kind of in relation to what you said earlier about investors potentially being too hands-on. And I think that startups should also think about, one investor may not solve all of your key needs. You know, building a syndicate, I think, is really important when you're investing, because you can have investors that focus in particular areas and they provide that expertise, or they have those patterns and data points that kind of Nadia alluded to within that area. I think that's really important. You know, from our perspective, honestly, we were investing in a company that is a synthetic biology company. We are not biotech experts and we don't pretend to be, but the synthetic biology company wanted to domesticate wild type microbes for biomass chemical digestion. That's a lot of stuff there, but there's a climate focus, pretty much is what I'm trying to say. And so when we, participated in that round, there was a biotech VC that was a partner to Prime for this company, because we were combined what that company needed to get to the next level. And so I would encourage startups as well, when you're going out and thinking about raising money, not only focusing on one investor to meet all of your needs, but being really thoughtful and intentional. And obviously this could take time, and it depends on whether, investors are open to it, and there are a million other factors. But similarly, as you would build your advisory board or what have you with people with different skill sets, I think you can think about investors in the same way, such that you're bringing the right partners to the table.
Totally agree with you. I would just throw a couple of other thoughts in as we kind of think about that original question. You brought up the topic of milestones, Amy, and I think it's a really good one. One thing I think, regardless of what stage you're investing in, is you're looking to see that a founder is setting and hitting milestones, and that consistency builds trust over time. And I think one of the most detrimental things to any founder-investor relationship is setting really unrealistic expectations and then, kind of consistently not hitting them. That is really, really difficult, both in a raising process and then also, post-investment. As I kind of take my OpenView hat off and just think about investing generally, I think the other advice I would share is really knowing and understanding the metrics of your own business and what you have the ability to influence. Different investors are looking for different things. So there is not some hey, playbook on you need to hit these things. And as an example, I was talking to a company recently who had very low gross margins, but they addressed it really quickly and head on and said, we're at this percentage now. We see a path to more traditional software gross margins, but we're investing ahead of our growth because we know we have 3 big customers coming on. We need, the cloud storage space or whatever. And we have a reason for doing that and a path to getting the metrics you want. And the ability to both have a strategic conversation about why you would make that choice and the understanding of those underlying metrics, it removes a lot of the concern and shows that as a founder, you're willing to engage in that conversation and think about what levers you can pull. So, my point there is just more macro in that it's not hey, here are the 8 metrics you have to hit. It's more understanding the investor you're talking to, what they're optimizing for, but most importantly, really having a handle on your own business and showing that you understand those levers you can pull. So just wanted to add on with that, Amy.
Yeah, I totally agree. I think it's a very great point that you measure, important to measure what is important, measuring something that can you can communicate and align on. There's the point, Amy, you were making on not data points but trends, right? The starting a fundraise process early is the message. I think is communicate trends, show trends, not isolated data points. Don't start a fundraise today if you need the money today. Start it 6 months ago if you need it 6 months from then. And that ties back, I think, strongly to the interpersonal piece. There's a interesting question that I want to pull out from the chat. This one, I think, was it was Donna. This was a while ago. The question reads, this is from Murph McKeon, there are different inflection points for companies and founders which may create need for change for the company. For example, a different CEO, right? This can look very differently at different stages. But so the question is, how have you worked with founders? I think this can go both ways to make this change. This can get juicy real quick. Especially if we focus on the need to change the CEO. Maybe, Donna, if you have a...
Absolutely. No, a ton of stories here. And I think when you think about any startup, for the team that is determined to solve that problem or bring that innovation, it is personal. It is their baby, it is their heart, and it's their soul. And, you know, everyone always talks about this notion of, do you want to be rich or do you want to be king? And I don't like that tension, you know, because it just, you know, it's like both of them are these negative extremes. I think it comes down to one, knowing your strengths, and what you excel at, and how do you cover your blind spots, and then two, thinking about what's really necessary for your venture to reach that next stage. So for example, we're talking about, I think Amy, we're saying like, hey, some of the CEOs I work with or postdocs or grad students or first-time CEOs, it is really typical with things coming out of universities where the postdoc who starts that company, you know, transitions to another role at some point. And it's you know, like those expectations are clear that you are probably not going to be the CEO of this company forever. Or you're probably not going to have that role. So typically we also caution teams, don't make everyone a C-level person. What happens if they can't scale? And then you have to put someone over them, and having those really conversations. There's a ton of founder guides online. I would encourage any founding team to go through those founding guides, have that conversations with yourself, so you don't actually get blindsided later. So on the transition, I can use myself as an example. You know, just going back to last two companies, at UPromise, we had 3 different presidents. Yeah, 3 different presidents before we were acquired by Sallie Mae. I can tell you wonderful things about every single person that served in this role, have a relationship with at least 2 of them, still to this day. But they were interested in what was going to be best for that organization over the long haul and where they scaled. You know, some people talk about being a nail it person versus a scale it person. Know the space that you personally really want to play in. When we started Care.com, we all had to wear so many different hats. And I tell this story, I have given up so many things that I love doing and roles that I loved playing, because they reached a point where we discovered there was something there and there was somebody else who was better qualified to come pick this up because you were needed to do something else. The LTV class that I teach right now, the protagonist comes in at the end of the case and sort of, you know, shares their perspective. And so many, you know, it's like, well, I switched to being a board member. One founder said, I realized I was a creative, you know, like, here's what I really love doing. I loved working on the product. I really hated all of the other stuff. And there was somebody else on the team who could play that role. Those are like the best case scenarios. And some scenarios, it's not always an easy conversation, and it does have to be handled with care, because we're dealing with people and it's all about those long-term relationships. For anyone who, I think Bill let makes everyone watch this horrible movie, Startup Inc. And, you know, these guys they thought they were going to be huge before there was reality TV. And you go through and you see how brutally honest they were with each other, like just brutally honest. And you're thinking, oh my gosh. And then you hear at the end of it, it's like, oh yeah, they've done multiple companies together again in the future. Yep. You know, they fired each other. They moved each other into different roles. But because of their ability to have those honest conversations with each other and be really clear about what they were trying to accomplish, they realized they were actually a pretty good founding team and did really well together.
So we are about 5 minutes from needing to wrap up here. This is a phenomenal conversation. I don't know if any of you wanted to add to this last point, some of the points Donna hit on. We can do that, but what I want to do is open it up. I think we pulled some of the themes from the chat, and one of the ways that this last question manifests itself as to how do you manage change when you're at the executive team and investor governance level. There's a question in there as to, from the investment standpoint, I am at a startup lacking some key hires, but we fill those areas of expertise with advisors. How does this look to investors? I think that is a very good example for how this change management manifests itself. It's sort of, rather than think of it that way, what I'm hearing from Donna, Nadia, Liz, Amy, is communicate it, talk about it, be honest with what roles, what are you good at, what you're not good at. So why don't we go around, if just impart last final words of wisdom that you any of you may want to impart. If there's a pressing question, throw it in the chat in all caps. I will see it, and we will call it up. But Nadia, you want to kick us off?
Yeah, my parting, I think most of what I've seen is entrepreneurs in our participants. So just from from the founder's perspective, what I would advise or call out is that when you are evaluating, so investor due diligence on the company, on the founders, but if you are true to yourself and are really want to set this good foundation with investors, you should also do diligence on investors. How do you do that? There's so many different ways, but one way, again, listen, when you're interacting with investors, especially if there's more than one investor at the table or whatever, you're having drinks, is how they talk. When investors get together, what do you think they talk about? They talk about their portfolio companies. This is their life, right? Your life is your company, their life is their portfolio companies. And so listen, how they talk about these companies and how they talk about these founders, and put yourself in the shoes of those founders. Is that respectful? Is that constructive? Is this where you would want to be? Sometimes it's a fit and sometimes it's not. And if it's not a fit and it kind of pierces your ears, don't think like, oh, this is probably something to be cautious of, and this is something as part of the due diligence to take into consideration. So that's like my little 30-second sentence.
Add on to that, Will. Like, I have something to say. Just, it could also be my parting points about due diligence on investors, which I was thinking about, prompted by Nadia. I definitely think people should do due diligence on investors, being on both sides of the table. So not only speaking to portfolio companies, I mean, connect with portfolio companies in whatever investor you're looking at, because I think investors often wouldn't connect you with the portfolio company until you're pretty far down the diligence process. But I would also say, actually ask them about their diligence process as well. And what are the things that they focus on? Everyone's very different and there's no right or wrong answer. But depending on what your business needs and the areas that they're trying to optimize for can tell you a lot about how they're going to be, investors, should an investment go through. Are they trying to break everything down into really discrete milestones so they can do tranched investment, which could be great for you, but could also be terrible? Like, I would ask them about their diligence process and some of the key areas that are critical for them to move forward, because I do think that will tell you a lot. So those are my two parting words.
That is amazing. Liz, I want to sneak you in before you have to hop off.
Yeah. I'm going to build on that too, actually, because I think there's some great points coming out here. I totally agree with both of you guys on diligencing investors. And the one piece of advice I'll share on that is don't only diligence their winners. I think that VCs are quick to introduce you to the companies in their portfolio that are, doing great. But Donna, to your earlier point, you're picking a partner for any stage of your business. And if there are rough periods, you want to know how that, investor is going to act, and if they're going to stand by your side and help you get through it. And I think having conversations with, some of the tougher investments they've made, where either they, made the wrong bet on the market, or there was, a competitor that just kind of came up, having those will actually tell you probably a lot more about the relationship you'll ultimately build. But thank you guys for having me. This has been an awesome conversation. It was great to meet all of you too.
And thanks so much, Liz. And Donna, you want to bring us for a landing?
Absolutely. Just adding to what everyone said about the diligence process, we've all made the assumption that you can get that meeting with the investor. So wanted to pull back on realizing, especially for some of you who might be, say, students dealing with your first venture who may not have that network. Take advantage of every opportunity. So if you want a relationship with the investors on the panel, definitely hit them up on LinkedIn right away and send them a note about something you enjoyed hearing from them. But with all the information out there, you can somewhat follow everyone online. You could read what they're blogging about. What are their teams reading? What are they thinking about? Who did they currently invest in? Who are they doing deals with? And then you don't have to wait for them to introduce you to their portfolio companies. You can reach out. Most entrepreneurs are always happy to have a conversation. And if you can't get to someone who was actually sort of part of negotiating that deal, you can definitely network your way in to have a conversation. And then definitely go hear what they have to say out in the world. And then once you have that meeting, all of the fantastic advice about their diligence process, their timeline, what kind of deal, where they are in their fund would be super helpful for you to know. So you get a sense of what are your chances?
All right, so with that, we are done here. I want to thank the Startup Boston team, hand it over to them. We heard, I think, three main themes: communication, trends and stories, not just isolated data points, and educate yourself so you can get to this higher order thinking that is beyond the information out there, beyond the books. It is way ahead of way ahead and gets to the productive relationships that I think we're trying to talk to get at here. So thank you, everyone. Thank you, Liz,
Thank
Amy,
you, guys.
Donna, Nadia. This was fantastic.